Hello and welcome to Accredited Real Estate School's fourth quarter 2021 real estate market update. I'm Bryan Church. I'm the founder and chairman of the board of directors with Accredited Real Estate Schools and founder. We started in 1995. So let's go through. This is on September 30th. We're going to be doing the fourth quarter update. So let's get going. The fourth quarter of 2021 looks to be an uncertain and volatile period for investors. Eviction Moratorium has finally ended. The Fed is tapering, which of course is reducing purchases of U.S. Treasury bonds and of course bills and Treasury bonds and mortgage-backed securities. And China's huge real estate development companies are not being bailed out by the Communist parties. Those are the things that are coming up. They're going to have an effect on the fourth quarter for real estate. Let's look at the first one, the eviction moratorium. Eviction moratorium has finally run its course. Both federal, which of course is the Center for Disease Control, state and local governments were involved in keeping tenants living in rental properties even though they were not paying rent. Federal government sent money to the states to help pay for the lost rent. However, many of the states did not immediately spend the money where it was supposed to be spent, but used it to shore up their state pension systems that were at risk of default. Recently, some states have finally started paying the money out to tenants and property owners who were affected by the COVID pandemic. And one of those states is California, where California has had issues. And you have to remember, states do not have the ability to print their own money, whereas the federal government does. So they can print money up, give it to the states. The states can use that to shore up their pension situation. Not only does California have issues with it, but some of the other states like Hawaii, the island of Maui, what they did is they have very low property taxes, but they've got a shortfall on their pensions. And what they did is they increased the property taxes. And then once that money has come in and they're using it to fix up the pensions, then they went ahead and put the property taxes back down to where they were. So that's one way that I guess you can do that. And that's, of course, an eviction moratorium was difficult because of the many properties under the eviction moratorium will be making their way through the eviction courts and should be emerging sometime later this year. So the ones who are being evicted will end up being, evicted from the properties. Some of the single-family homes that were under the eviction moratorium may go on the market for sale later this year, but residential real estate is projected to stay strong because people continue to move out of the cities looking for less crime, density, exposure to COVID and things like that. So the residential real estate looks pretty darn good for the future. So if you're in investments in single-family residential real estate, that's actually preferable to the apartments for the simple reason that the apartments don't have the ability to change use from owner-occupied to non-owner-occupied. And of course, single-family homes that have the advantage of being able to change from non-owner-occupied rental property to owner-occupied home that will sell for a higher price due to a low interest rate and high loan-to-value from owner-occupied financing. What that means is that you can rent out a single-family home as non-owner-occupied, and then when the owner-occupied market is up, like it is right now, you can convert that over and sell it to an owner-occupied buyer who will pay a lot more money than an investor will. Because the investor is just looking at, say, a 5% capitalization rate. That's the return you get if you pay all cash for a property, is the capitalization rate. They're looking at 5%, but the rents that they have, it may not cash flow very well, whereas an owner-occupied buyer can come in and buy the property. They don't care about rents or cash flow. They want to buy the property and live there. And so with the low interest rates, they may be able to pay more money to buy it. They also allow higher loan-to-value ratios with owner-occupied up to, some of the programs like FHA is 3.5% down, Fannie Mae has a 3% down, so only 97 and 96.5% loan-to-value ratios, which put a lot of buyers in the market, and of course it increases prices because of that. Many of the single-family properties coming out of the eviction moratorium will be sold to owner-occupied buyers who will pay significantly more than a real estate investor who is looking at a 5% or lower capitalization rate. Return the investor will receive if he or she pays all cash to purchase the property. So real estate investors are looking to move the tenant out of the property, rehab, of course, for sale, put it on the market, close escrow with the owner-occupied buyer as soon as they can. Those are the ones who want to get out of that business. Of course, the apartment buildings don't have that luxury. They're going to be using them for rents. So if there's another issue like growth moratorium, or excuse me, eviction moratorium that comes in, they could end up getting hammered again. And here's another issue that the real estate investors have is where, after you sell the property, where are you going to put it? And that's a real big issue. They'll be looking to do an Internal Revenue Code 1031 tax deferred exchange and move the money into another rental property for the capital gains taxes into the future. So what happens is the people who have gotten hammered with those single family homes may actually take that money and they may sell it and do a 1031 tax deferred exchange out of it. In California, you'll see a lot of people who do the 1031 tax deferred exchange, but there's some issues in California you probably need to either remember, or maybe you haven't seen those in the last few years. Real estate owners in California may not realize that the California exchange rules changed a few years ago and require 1031 exchanges where the seller, that's of course the relinquished property in a 1031 exchange, moves the money out of California into another state, which is the acquired property. They must continue to show the deferred capital gains amounts that are still payable to California on their California income tax returns each year. So that could be an issue, because this may not seem like a problem for real estate investors if you hold other properties, because you're going to be, of course, filing your returns anyway, right? But if the seller or relinquished property does not have other holdings in California, he or she will still be required to file a California income tax return for the relinquished property every year in the future, which will be a pain because they don't have anything going in California. You still got to keep filing the tax returns. And there's another thing comes up too. More importantly, and this will be, of course, could be even a punitive type measure. Could flag an audit with the California Franchise Tax Board, because they want to make sure that you still have that money there. So even though you may be filing your taxes, you could just still end up getting audited by the California Franchise Tax Board. So for this reason, real estate investors can pay their capital gains taxes to California while exchanging the federal portion into another state to be deferred into the future. I know some people who have done that over the last couple of years. But what's happening now is that some real estate investors have decided to do cash out refinances on their properties in California and move the money outside California without having to do 1031 exchange at all. This defeats the reason for the Internal Revenue Code 1031 tax deferred exchange in the first place. So it's happened. California is trying to keep those capital gains and capital gains taxes in California, even though you move it out. So before you're able to move it out of the state to another state, and then you'd end up paying it sometime down the road. Your heirs would end up paying it probably. And so that's going to be a difficult situation when we have these properties now that you have to keep the money in California or pay the capital gains taxes on them. And so what some of the investors are doing, they're saying, well, then if you're going to do that, we're just going to do cash out refis, move the money out, and then we'll just leave the properties here to kind of just, keep on keeping on. So the reason the U.S. government has allowed 1031 exchanges is so that real estate owners can move capital gains out of non-productive properties and into more productive properties while deferring capital gains taxes into the future. Now, what this does is the property owners will either exchange into another California property where the California Franchise Tax Board can track the deferred capital gains taxes right in California into the future, which California likes because they'll get their money at some point in time. Or not do the 1031 exchange, use cash out refinances to pull money out of the property, move the money into real properties in other states, thus leaving existing properties in California without any funds available for normal maintenance. With low interest rates, the cash out refis look real attractive right now. And so that's what we're seeing some of the investors are doing. Now, the only thing is that this in turn causes real properties in California to become blighted and reduces the quality of rental housing in California. Another case of politicians in California not considering the unintended consequences of their actions. And these are politicians not only in California, but in all the states and the federal. They don't look past the first move. So you have a lot of unintended consequences from their work. So the one thing by trying to keep that money in California, they cause investors to make an end run with the cash out refis, and then they won't use any of the money to upgrade the properties. They end up going into disrepair. Another stupid move by people who don't know what they're doing. Okay, so that's our first thing we're having to deal with. Okay, and then the second thing we have is the Federal Reserve. Now, Federal Reserve is the central bank for the United States, and we call it the Fed. And the Fed has signaled that it is going to start tapering purchases of U.S. Treasury bills and bonds and mortgage-backed securities. So bills are the shorter-term treasuries, the bonds are the longer-term treasuries. So they're going to start tapering these purchases. And this is a form of tightening that reduces liquidity in the market and causes the 10-year treasury bond rate to move upward. So what we're talking about here is the Federal Reserve they are buying treasury bills and bonds. What happens, the U.S. Treasury issues these treasury bills and bonds, and then the Fed, of course, whips up the money out of thin air, prints it up out of thin air, and then buys the treasury bills and bonds that, of course, puts liquidity back in the market and keeps the market going. And they do the same thing with mortgage-backed securities. Now, what these are loans, real estate loans, that are grouped together. So let's say a lender makes a real estate loan, and that loan that they have, they will put together with several other real estate loans. They're called tranches, and they will sell them to investors on the secondary mortgage market. And so what happens is that the Fed is actually going in and buying those as well. They're printing up money out of thin air and buying those as well, which puts liquidity back in the market. And, the market is kind of like a drug addict. Once they have the drug, if you take it away from them, it can get really nasty. And so this tapering could be really, could turn into a little bit of an issue with increased interest rates. Fed will begin tapering in November 2021. They're currently buying about $120 billion per month. $80 billion in treasury bills and notes, and then the other $40 billion in mortgage-backed securities. This amount will be reduced to $15 billion per month, which is $10 billion treasuries, $5 billion mortgage-backed securities. At this rate, the taper is expected to be completed by July 2022, and at this point, money printing will be over, and the Fed is expected to start raising interest rates at that time. Now, they're saying they're going to be raising interest rates, but I can tell you that they're not, because they won't be able to do that, but that's what they're saying. The 10-year treasury bond is used by lenders to price long-term 30-year fixed-rate loans used in many real estate purchases and refinances. The reason lenders use the 10-year treasury rather than the 30-year treasury is because people tend to keep their loans between 5 and 7 years. So the 10-year treasury bond rate is more indicative of the realistic lending risks. That's why we always use the 10-year treasury. And right after the Fed's meeting here last week, the 10-year treasury went up significantly. And but the projection is by the hedge fund advisors that I have in contact with on Wall Street, they think that it's going to go back down. So we'll see how that goes. The Fed may be tightening when business wages cannot match the amount being paid to people receiving unemployment benefits. This amount has reduced recently, so many unemployed workers will be forced to go back to work. Until this happens, disinflation, which is a reduction in the rate of inflation, may be the result. So this is not deflation. What it is inflation will actually slow down. And remember, with inflation, you have to have velocity of money. Money has got to be spent. And everyone's scared right now, so they're saving their money. And so you see some increases in prices with food prices and things, but the overall market is still looking to be deflationary. We're going to talk about that in just a second. Okay, so the Fed's tightening when they probably shouldn't be. And of course, you know what's going to happen with that. Could have some major issues coming down the road. Now, demographics show the large baby boomer generations retiring, and they're selling. They're not buying homes. The question is, if interest rates go up, who will buy their houses and for what price? Baby boomers are deflationary to the U.S. economy because they're usually sellers, not buyers, and they don't buy anything because they've already bought everything. Right now, they're divesting of things, so they're definitely not inflationary, but deflationary. Another thing that's deflationary is technology, and technology is automating formerly labor-intensive jobs, so workers need to retrain themselves to be cast into the ranks of the unemployed. Congress wants to spend money on social programs to help unemployed people survive during a technologically driven world. Technology is deflationary to the U.S. economy. And one good example of that if you've purchased a house, or maybe or you may be a real estate professional and use these, deal with real estate transactions all the time. But for example, when we do the contracts on a purchase of real estate, a lot of times those contracts are electronic now. And those electronic contracts, they use something like maybe DocuSign or one of the other ones, and you actually sign the documents electronically. That saves so much time. And for that reason, you're finding that technology is deflationary because it is actually reducing costs in a significant amount and significant rate. Deflation occurs when the US dollar becomes more valuable. This benefits lenders who receive loan interest and principal payments in US dollars that are worth more than when they were originally loaned to the borrower. In contrast, inflation benefits debtors who are borrowers, right, who are paying back a real estate loan with cheaper inflated US dollars. So if you think inflation is going to be on the horizon, then it would be a good idea to take out a long-term fixed rate loan. And the thing of it is that even though we're experiencing deflation right now, we know that inflation is eventually going to kick in. The federal government's been trying to get this inflation for over a decade, and they haven't been able to do that. But with all their money printing ideas under their modern monetary theory, what they're going to do is they're going to, at some point in time, it has to start hitting inflation. And unfortunately, we think it probably is going to hit hyperinflation when it does that. The Fed thinks they'll be able to keep it under control, but they won't. But we don't know when that's going to be. That could be a few years down the road. So a lot of times the investors now, what they're doing is they are taking out loans because the interest rates are so low. They're getting long-term fixed rate loans. And then when there is some inflation kicks in, then when they have these loans, when they pay back the loan, let's say several years from now, they're going to be paying the money on that loan, they'll be paying it back with dollars that are inflated. In other words, the money that they're using to pay back the loan is going to be worth less than the loan funds they're receiving today. And so, for example, let's say that you have a property that's worth $200,000, and you come in with a $100,000 loan, and you put $100,000, down payment, which is your equity in the property. Now, that $100,000 loan that you just took, let's say that 5 years down the road, there's hyperinflation, and your interest rate, say, was 3% on that. And when inflation kicks in down the road, what will end up happening is that all the dollars that you're going to be getting in income, right, will have increased. So your wages may have gone up, doubled what they were, but your loan amount still remains the same at $100,000. So then you pay back the $100,000 loan that was made 5 years previously with US dollars that are inflated, and they may be worth half of what they were when you got the loan. So now you're paying it back with with loan funds that are maybe worth half of what they were when it was purchased and the loan was actually originated. So this can be a very good thing for borrowers when we think that the inflation is coming in. The question is, we don't know when it is and how severe. Add the fact that people are not spending money but saving it because of perceived economic uncertainty, which of course the pandemic-related shutdowns are one major cause of that, and political instability. And one example there is the Afghanistan debacle. The velocity of money has continued to decrease. Velocity of money is needed for inflation to occur. So people have to keep spending money to get the velocity of money up so that you can have inflation. Right now, we're not seeing that. So again, we're seeing some food price inflation, but everything else is indicating disinflation, which is a reduction in the rate of inflation, and deflation, which means it goes the other direction. Okay, so that's what we're looking at right now. And therefore, food prices are increasing, but the overall framework for long-term inflation is still a couple of years away. And nobody knows how long it is going to be or when it's going to be. But we're pretty sure that it's going to happen. It's just a matter of when. Inflation and even hyperinflation will occur in the future. There are questions: when will it occur and with what intensity? Investors have started investing in inflation hedges to prepare for hyperinflation in the future. Real estate's traditionally been an excellent inflation hedge, and low fixed rate real estate loans benefit the borrower, so real estate has been seen an increase in investor demand. So that's actually been good for real estate. So we're seeing a lot of movement in the real estate business right now. Let's go to China. And this is our third one that we have. And China has allowed large real estate property developers to use wealth management products to finance real estate that's been built in China over the last several years. What these wealth management products are, They're a giant Ponzi scheme in which new investors' payments are used to pay monetary returns to previous investors. What they do is they take a bunch of money, they pool it together, then they spend it on whatever they want. And a lot of people think that it's backed by the bank that may be doing the wealth management product or the development company. And they have just hundreds of and even thousands of these wealth management, actually, probably way into the thousands wealth management product that are out there that the investors don't even know what they're backed by nothing. And what they are is a Ponzi scheme because if the investor wants to pull their money out, they just get somebody new to invest in and they give them their money. So it's a mess. And some of the more astute forecasters, I should say, astute forecasters have predicted that these are going to go belly up here at some point in time, and look like the first one is starting right now. So real estate construction has been a large part of China's economic development, using these wealth management products to finance large deserted ghost cities has worked well as long as more investors could be found to invest in the real estate developments. When new investors cannot be found, the company will go into default. So if you're investing in these, you don't want to be the last one or you'll be in trouble. Evergrande is the largest developer in China and used wealth management products to finance its development activities. These are real estate development. Evergrande recently could not make interest rates on one of its bond issues, thus indicating the first signs of a problem in the Chinese financial system. The communist government has bailed out large wealth management products in the past, but decided this time not to do so. They're wanting them to stand on their own 2 feet, which of course they can't because it's a Ponzi scheme. China's communist government wants to change its model for economic growth and as a result is letting Evergrande fail. There were mass protests by Evergrande investors who lost all their money investing in wealth management products that's now worthless. See, people that don't understand that China are communists, and communists, they don't care about anything except keeping power and control of the government. That's all they care about. So if the people in China lose money or outside investors lose money, they don't care. They don't care what happens as long as they keep in power. And they're more concerned about managing the social unrest from the Evergrande investors, picketing and causing trouble than they are anything else. Most important thing, however, is that this is only the tip of the iceberg. Other real estate developers that have used wealth management products to finance their developments may follow Evergrande into the abyss. Yeah, matter of fact, the number 2 one is in trouble, and they think there may be thousands more coming down the pike here on that, and that is not good for China, but it's also not good for the United States because what they have is going to spill over, and especially, of course, Australia, they're tied in very closely with China on economic, even though from a political standpoint, they're really not getting along, but the economically they're going to get hammered on this, and the U.S. will see this also, as well as the European markets. So this could be an issue. So there's a possibility of market contagion as these companies start to fail and affect liquidity in international financial markets. In fact, some Wall Street experts believe there will be a stock market crash in October of 2021, and this may be the catalyst. That's their prediction. Now, trying to predict the stock market is very dangerous. Like they say, trying to short a stock market crash is a great way to go broke. And even if you're using derivatives, and you're doing it that way, it still can be a very dangerous way to do things. So just a caution on that. They say in October, it could be anytime. They've been predicting this for a long time. It's just that with the wealth management products, everybody's thinking this might be the catalyst that does that. So what we're really looking at is areas consider investing in the next few years. And this is just an idea that of where, that money might be made or at least preserved, First one's residential real estate. And the reason is it's an inflation hedge when the US dollar devalues, which of course is inflation, and a deflation hedge because future market rents are paid in more valuable dollars than the investors are receiving today. So if you have an inflation, real estate tracks it usually really well. The value of the real estate will do that. You also may see some rent increases in rents, which is of course nice as well. But if we do go into deflation, back in the the Fed is not able to get inflation, we get deflation, then there is a deflation hedge because the money that you're going to get later on is going to be worth more than it is right now, completely opposite to inflation. And one of the reasons, by the way, that the federal government wants inflation is they want to pay back the national debt with cheaper dollars. So that's why they're doing that. Second thing that looks real good is physical gold because it's an inflation hedge and it usually increases in value during the devaluation of the US dollar. Here recently, it's been acting kind of weird and not doing that, but it usually does that because there's been some issues in the paper gold market under something called Basel III. They're having to come up with actual physical gold, so they've been artificially forcing prices down so they can buy the physical gold cheaply. So there's been a lot of market manipulation in gold. So don't put too much in gold because of that reason. But you want physical gold like American Gold Eagles, things like that, not paper gold. And what it does is it's a safe haven against market turmoil because inflation hedge usually increases in value during that, but also it's a safe haven. So when there's problems in the market, which could be coming down the road, especially with the stock market, maybe some huge adjustments, you may see gold being used as a safe haven, and that'll drive the price of gold up quite a bit. But again, be real careful because gold's been manipulated quite a bit. And the reason that the government had allowed that manipulation is that in 1971, the Nixon had gotten rid of the gold window, so what could happen? People could take money from outside the United States and redeem gold, their money for gold, and they didn't want that to happen anymore, so they stopped it. But they allowed this paper gold to occur, which is a really over-financialization of it, where the people could actually sell gold and they would have the supply of gold, but they never had any of it. They were actually playing with gold they didn't own. So they've been doing that for years. And they did that because that way they could keep the fiat currency, the US dollar would stay strong, and there wouldn't be problems for having a gold standard. Well, that's all coming to an end right now. So gold looks like it could go up. And one of the, matter of fact, projections, and one of the very, very astute people who I follow quite often thinks that gold could hit 10 to 15,000 an ounce. But again, don't go too much into that because I found that real estate's a better investment because you get return on the real estate while you own it, whereas with gold, all you get is price appreciation. Now, cash is also another good deflation hedge. So if it goes into deflation, so when it increases in value over time, you can use to buy stocks after severe market adjustment. So a lot of the investors are holding a lot of cash right now, even though they may not tell you that. And with that money they're going to use that to buy very, very well priced stocks after the market adjustment. So they're just waiting to do that. And it's also a deflation hedge as well. Fourth thing is U.S. Treasury bonds. And because what happens is bonds experience an inverse relationship to interest rates. Since interest rates are expected to stay low, bond prices should maintain their value in the future. So the 10-year treasuries started looking really good maybe about 6 months to a year ago. And so a lot of the investors have gone in there, and their interest rates, again, are really expected to stay low. And of course, that'll be nice down the road as we get closer to inflation really kicking in and hyperinflation. You'll have people doing a lot of long-term fixed rate loans so they can take advantage of the fact that they're paying back those loans with cheaper dollars in the future. And then the last one's a very limited number of stocks in energy, natural resources, defense, and healthcare because these sectors are expected to weather the stock market correction in the future. So some people are keeping some of their stock in those areas, but a lot of them are just selling because they want to get out of there and paying their capital gains and move it into other assets they think are safer. So anyway, that's what we think is going to happen in the fourth quarter, and of course, also maybe up the next several years. And that's about all we can come up with now. We'll, of course, be coming out around the first of the year with the first quarter 2022 real estate market update, and we'll see if how much of this has come true and how much hasn't at that point, and see if there's any changes we need to be making into our portfolio, especially residential real estate. It's a good thing to be in right now. Okay, so I'm Bryan Church and with Accredited Real Estate Schools, And this is our fourth quarter real estate market update. Thanks very much.